How's it going, everyone? It's Sam. Today I want to go over my top 3 holdings in my Roth IRA investment account that I just started about a month ago. And I want to go over them and talk a little bit about each holding that I have and why I have it. So we'll get started here. If you guys don't mind dropping a like below, I'd appreciate it, and I can make some more of these videos. So the first stock that we're going to talk about, my number 1 holding, it is Facebook, FB stock. As you can tell here from the graph, it's gone down about 22.5% so far this year since the coronavirus outbreak kind of started. So from February 19 through today, it's down 22.5%. Now it was down a lot further, but it kind of rebounded a little bit, and it's back at 22.5%. It's one of those big companies that can hold on to the market share a little bit better, hold on to their market cap a little bit better because it's such a large company, but still down 22.5%. So what do? They own, obviously, Facebook, but they also own Instagram and an app called WhatsApp. So they own Instagram. They bought it for about $1 billion several years ago and turned it into this giant powerhouse of an application. So a lot of people believe Instagram, if it was to be valued now, it'd be around 100 billion. So they really expanded what Instagram has done since they bought it. Now, I didn't really know what WhatsApp was, but it is a messaging app. A lot of droids, I believe, use it, and it's a lot bigger outside the US than it is inside the US. But it's still massive application, tons of daily active users. People use it all the time. So they have a ton of different people that are using their applications. Now, they're down 22.5%. Let's look at my position. I have $811 and some change in this stock. So I've been able to get it at an average share price of about $155. Now it's up to $168 now. I've been able to increase my equity about 14%, 13.5% throughout this investing process. That's time value return, so that's not exactly right for the return that I've actually gotten. I've gotten about $13 a share, so a little bit less than a 10% return overall. So that being said, it is my largest holding. It accounts for about 14.4% of my portfolio, which is significant. I have 15 different stocks, I believe, in my portfolio right now. So on average, I only have about 7% in each stock. This is by far my biggest stock position. Now, they are affected short term with everything that's going on right now in the markets and because of the disease. Now, the main way that they're affected is that there's less money for advertising budgets. A lot of companies have to make cuts. If they're going to be laying off employees, a lot of the time they have to also decrease advertising, decrease in all places in their business. So one of the first things that goes out is advertising. Now, they probably will make less money just from companies that aren't either willing to pay as much or less companies that are willing to pay. Now, at the same time, there are more people on the platform than typical. A lot more people have a lot more free time, especially here in the US and other countries, being at home, being furloughed. They have a lot more time on their hands. What do? You pick up Facebook and look at it 10 times a day. So I think that the reason that they're down is more of a general market trend than them specifically getting hit harder than other companies. The whole market is down 20-25%, so Facebook's down 20-25%. Short term, they're going to be hurt a little bit from companies not willing to pay as much per ad, but I think that it will bounce back as soon as companies have money again and can open up their businesses and are looking to expand instead of just trying to survive, which a lot of companies are doing that right now. Now, long term, I see this company growing a lot long term. I think over the next 2 to 5 years, they could double or triple in market cap and the revenue, all that kind of stuff. I think that right now. They've gone down 25%. Definitely see them getting back to where they were, possibly in the next 6 months or so, and then increasing from there. Now you can see, I'm going to show the revenue over the last few years. It has increased significantly. So if you look at 2016, about 27.5 billion in revenue, 2017, 41 billion, 2018, 56 billion. Last year they thought that the growth wasn't going to happen as much, but they came in at about 71 billion in revenue. Now those aren't the numbers of a $500 billion company. That's increasing the revenue so much every year. That was almost a 30% increase in revenue last year. And the fact is they're also increasing net income too. So 2016, about 10.2 billion, and it's gone up significantly. Now in 2019, they actually decreased their net income, but part of that was just due to some of the fines that were put on them by the government. But they increased significantly every year up until then, and then I think that they'll be able to increase net income again after that, since they won't have to pay those fines this year. Now, they're making more money every year, they're expanding. Where is the business going? I think that the business will get more and more ads every year, a lot more money for ads, because I picture people going more digital. A lot of the older companies now are starting to get away from print and TV ads. People are using the internet a lot more than they ever have. People are watching less TV. I mean, people, my peers, aren't going and watching cable every night. They go home and watch Hulu or Netflix or YouTube. They go on Facebook. They don't typically spend 4 hours watching cable TV. So I picture people going a lot more to the internet, and therefore Facebook is one of those major platforms that will still be there. Now, Facebook is someone that a lot of people used to think would go out of business, or maybe not go out of business, but would lose market share because they thought that it was really easy just to create another social media platform. They thought that Twitter was going to get big, and Snapchat and all this other stuff that was going to take over Facebook. But as you can tell, Facebook is very sticky. Twitter has decreased a lot over the last year or two. Snapchat has decreased, people aren't using it as much. But Facebook really has a grasp on the older generation. I think they moved over to Facebook and are using it, and that's really their first social media platform that they got really comfortable with. And the other thing is, a lot of the younger generations, like my friends, go on Instagram a lot. Now, Facebook hasn't really monetized Instagram all that much. They haven't put too many ads in there compared to Facebook, where you just scroll and then you see an ad. But there's definitely time for that to be implemented and to increase their revenue. They've been growing their cash reserves for the last 4 years significantly. They are a $500 billion company that has $55 billion in cash. They have a lot of money. I don't picture them having any issues in the short term being short on cash. Now, a lot of cash is great, but without looking at their liabilities, you don't really know how they're doing. Their total current liabilities is only $15 billion. Now, $15 billion for any other company besides one of these major companies would seem like a lot, but when you have $55 billion in cash and you have $15 billion in current liabilities, that is a very small amount. All of their liabilities in general is only $32 billion. So I don't imagine them having any issues in the short term. They have a great balance sheet. They're increasing their revenue and net income every year. I think that they have a lot of room to grow too, and companies moving more towards their digital advertising. That's why they are my number one holding. I think it's a very safe holding, but they also have a lot of room for growth too. And poof, I changed clothes. I had to stay up late last night doing some research for this, so this is next day. Sorry about the change of clothes, but my number 2 stock is Foot Locker. So with Foot Locker, what do they own? they don't just own Foot Locker, they also own Champs, Foot Action, and East Bay. So the three most well-known are probably Champs and Foot Locker, and then East Bay right behind. For any athletes, East Bay is probably something that you know. They have catalogs, and it's one of the last things that I've seen people actually flip through catalogs for, younger people, because they have so many different options of colors and types of athletic wear. So they own these 4 companies along with a couple other. Now they are down 44% so far, just since the whole disease situation started. So in a month and a half, they're down 44%. They were down a little bit further, I think right past 50%, but still down 44% today. They've come up 20% and then 5%, I believe, over the last 2 days. So they're starting to tick back up. Now I own 12.4% of my total portfolio in Foot Locker stock. Now they are affected short term in that they had to close down all their locations or physical locations for Foot Locker, and I think Champs too, which hurts because most people still like to do shopping for that kind of stuff in person. Again, everything's shut down like I said before, so it's difficult for people to want to buy shoes and athletic wear when they can't wear them for games and stuff like that. A lot of the business that they do is with athletes, so if there are no athletic sporting events, it hurts. This is, however, the best time for them to be shut down. They have summer coming back. There's going to be a lot of pent-up demand for all this kind of stuff. A lot of people are going to be out and active during the summer. Then there's going to be back to school shopping in the fall, and then there's going to be holiday shopping around Christmas, and once school sports are back in session, people will be getting a lot more stuff too. Now, where do I see them long term? Well, a lot of people are moving towards online businesses to buy stuff. Physical businesses aren't doing as well as they used to, but I will say this, people still liking athletic clothes in person, especially shoes. So it's great to grab some jacket or something off the internet if you get a good deal, but a lot of people want to get the stuff that they're going to perform in person. They want to feel it, they want to see it, they want to know how long it is, how baggy it is. They don't trust buying something online, and no one likes returning stuff online either. So I will say that. Also, like I said, shoes especially, people liking in person. They try them on, they look at them, they flex, they jump a little bit, they run down and back the aisle. People like buying that in person. So long term, I think people will continue to go here and they'll make good money. I don't see that as an issue. Now, let's look at their financials. So that is the most important thing for many companies. They have a total revenue last year of $8 billion. Okay, so this is about a $2.3 billion market cap. Revenue of $8 billion. Net income of almost 500 million. It's hit or miss each year. It looks like it goes up and down, but 500 million on a $2.3 billion market cap. So what you're doing is you're buying this between 4 and 5 PE ratio. So ton of money coming into this business. They're able to hold on to a good amount of it, and they're going to be a cash cow, right? So you're buying this for, let's say, $2.3, and they're returning to you 50 cents each year. That's a good investment. That's over 20% return there. So of course that is not guaranteed, but that's what it's at right now. Now they also have tons of cash. So they have $907 million in cash and their $2.3 billion market cap. So when you buy their stock at $23, right? So it's $23 right now, give or take. $9 of what you buy is cash. The rest is the business. So when you see that $500 million a year, a lot of that isn't accounting for all the cash that they have sitting on the sidelines. So you're really getting like $500 million in net income, and you're only having to spend about 1.4 billion on the actual companies, and then the other 900 million's cash. So they make a ton of money for how big they are. And they don't have any risk really of going bankrupt in the short term. I say that, but anyone could go bankrupt, but 900 million is a lot for them. Now they also have a great dividend, and that is how I kind of heard about them originally. So they have a 7.2% dividend right now. It's been higher. I bought some when it was over 8%. The payout ratio last year was just 45%. So very low payout ratio, really good dividend yield, and they've been growing it a lot too. So they've been growing it over 10%, over 11% over the last 5 years, and they've been just growing it in general for 9 years. Now, of course, that could be cut a little bit or be slowed down because of everything that's going on right now. They might want to keep their cash a little bit tighter to the chest there. But I think that in the future they'll continue to up it because investors like seeing that, and a lot of the investors are in the company themselves, so they want to see the stock do well and the dividend to increase. So it's a very high yield with a low payout ratio. That's just kind of the thing that attracts people to it right away. But then once you see the balance sheet, see what companies they own, I think it's very attractive. And that is why I had the position that I have. They're my second biggest company, and I own a pretty significant amount of them. So I own $700. For me, that's a large part of my portfolio. Like I said before, 12.4%. My average cost is just $22.50. And that's about what the stock costs now. I've been buying as it's gone down lower, but I bought pretty heavy at the beginning, and then I didn't buy for a little bit, and then just a few days ago when it was at 18, I bought a good amount more. So it kind of averages out. But I will continue to buy this stock as long as it stays low. I think that it's going to go up significantly. It's going to be a growth stock over the next year because I think it will get back to the 40s or mid 30s, and then it will continue to pay really good dividends. So I'm going to hold on to it then too, unless something fundamentally changes in the business. And then my third and final stock is Berkshire Hathaway. Now, if you don't know that much about investing, you might not have any idea what Berkshire Hathaway owns. The answer to that is they own everything. They are essentially an index fund in and of their own company. So they own a lot of companies fully, and then they have significant stakes in other companies. So some of the companies that they own fully are Duracell, DQ, also known as Dairy Queen, Geico, Fruit of the Loom. They own about 20 or 30 other companies too, but those are the most well-known ones that you would probably know. And then some of the companies that they have significant stakes in: IBM, American Express, Bank of America, Apple, US Bank, Wells Fargo, Coca-Cola, GM, Charter Communications, Southwest, Delta, Kraft Heinz, United Airlines, Goldman Sachs, Phillips 66, along with a laundry list of other companies. But as you can tell, they own a lot of different companies, and they own billions of dollars of these companies. It's not small, insignificant stakes. Now, the company itself has gone down about 20% since the whole disease thing happened. Their market cap's right around 450 billion, so we're talking about a massive company. Now, I own 10.3% of my portfolio in this stock. I have an average price right around 188. It's right around 185 now. Again, it's like Foot Locker stock where I bought it early and then I started buying again more recently. But in the middle, I didn't buy as much. So short term, they are affected like a lot of the economy in that a lot of their businesses are shut down. A lot of them are not working as much as they used to because the economy is shut down right now. In the near future, they'll open their companies back up and they will be able to make a lot more money again. Now, the thing about Berkshire, like I said before, is they're well diversified, and I think they have the chance to grow a lot. The reason I say that is because they have a massive amount of cash on hand. So they are a $450 billion company, but they have $128 billion in cash. Now, their the person that leads the company is Warren Buffett, among one or two other people. But he has been known as one of the greatest investors of all time. But in the recent future, he's gotten some flack for holding on to so much cash. It lagged their returns so that they weren't making as much money as the investors thought that they should or that they could. They didn't do as well as index funds for a while. Just because they built up so much cash, it was hard to compete because $130 billion is a ton of cash. It is a large percent of their business itself. 28% of the company is cash. So in the short term, that means that will help them a lot because they won't have the risk of going bankrupt like some other companies. And one thing that Berkshire Hathaway is great at is making acquisitions. As you can tell, they own a lot of companies. They didn't start all these companies, but a lot of these companies they bought when they were doing really well, but the other company was doing poorly and they thought they could turn it around. There were some stocks that they were able to get in the last recession with guaranteed dividends that were very high yields. 10 and 8% are just two examples of that. But they do really well in recessions because they hold on to so much cash and because they're willing to go deploy it. A lot of these other companies that have a lot of cash are just willing to survive for the short term. They just want to hold on to the cash and make sure that they don't bleed too much, while Berkshire Hathaway is looking to make money in these recessions. So they have a lot of runway with all that cash and the ability to buy other companies. The reason I have the large position that I have in the company is because they're very low risk because they have so much cash. They have a lot of good growth ahead of them. Because of that low earnings per share number, they will go back up once they start making money and the market sentiment is a little bit better. And it's a very safe bet for the long term. So if they continue to do what they do, they have so much cash flow coming in. They have so much money that they will do quite well. For example, they have been just a cash cow over the last few years, raking in the money and also being able to store it up. So I think that it will produce really good returns while also protecting from downside risk. So those are my three main stocks. I plan on those being my main stocks for a while here. I don't see anything fundamentally changing in how I invest. And again, if you notice, those are three very safe stocks with a lot of cash, good balance sheets, good growth opportunities. That's what I want from my core portfolio. That's what I want. I don't want to see my largest stocks going down 30% in a day. So that's why I have those big, massive companies. And Foot Locker too, I guess. They're not so massive, but they have a great balance sheet too. So if you like this, please again, like, subscribe. I had to spend a lot longer on this video than I typically do because of all the different photos and research, and the editing took a little bit longer too, but I appreciate it and I will see you in the next video. Bye-bye.